Hello everyone, my name is Vikas Agrawal and I am the founder of AltPort. Alt is your alternate and Port is your portfolio management services. So first of all, thank you so much for giving us good amount of patient hearing, I would say, in the previous episodes, whatever we've recorded. And as I promised, we do this session called Ask the Expert Show at AltPort. And with me, I have someone very special, Mr. Atul. So Atul, thank you so much for taking the time out from your busy schedule and agreed to speak to all our investors.
It's a pleasure to travel to your office, and best of luck for your move to the city.
Thank you.
And setting up a great business here.
Right. Thank you so much. So idea is that, how do we go about educating our investors?
Sure.
And empower them with more knowledge and wisdom.
I think I've been doing it for years. Right. Because I remember it started way back. CNBC used to have these investor camps.
Right.
And I remember traveling to various cities and having hundreds of investors.
Yeah.
And those were the days when, I think maybe 20 years ago.
Yeah. So you used to travel with Udyan Bas, so those days.
That's right. Udyan, yeah. So Udyan was Udyan Mukherjee.
Right.
He was a good friend. A lot of them at that stage, and you give a lot of credit for the way the market has evolved to this media.
Right.
Even something that you're doing or you're in the path.
Yeah.
That the investor has come a long way.
Yeah.
Investor has come a long way in India.
True.
And that has happened nothing but due to this education efforts. So I think it's a great initiative from your side, and I'm so happy to be a part of it. Yeah.
Thank you. Let me have the privilege of introducing Atul for those who are watching it for the first time. Well, he doesn't need any sort of introduction, but he brings about more than 3 decades of rich experience when it comes to equity investing. And having worked with Rakesh Bhaiya at Rare, perhaps would have been the different experience altogether. So I'm going to read his mind and understand that, he started off almost in 1991, I would say, and more than, 3 decades of experience. And, these kind of experience is very difficult to get. So let me first ask you my first question, because you worked with Rakesh Bhaiya. So how was your experience? Let's start from there.
I think he was a phenomenal man. And, with Rakesh ji, you can't really put him into a template. The reason was that I always found that, not only was he a great investor, which most people know of, he was also a great trader.
Yeah.
So it's very rare. They have very, very different mindsets. And he was also very successful in private equity.
Right.
So you will realize that all 3 skill sets require a very different mindset.
Right.
And a person's ability in the same day, in the same 8-10 hours to accomplish all 3 things and in his lifetime is phenomenal. So I think he was just, I would say, almost a statistical oddity in that sense of the term, that it's very rare you get somebody with that kind of talent, skill set and success. So as I said that when I met him earlier, I thought I could, put him into a template, into a structure, etc. But then you realize that he's just once in a generation kind of talent who excels at so many areas. So I think I have the highest of respect for his intellect and what he was able to achieve.
Yeah. So compartmentalization of the different framework, as you rightly said, is always been very, very challenging. And you said there are 3 aspects that he was hands-on in terms of doing whatever he was doing. But you started up your career with Parag Parikh, and that point of time, I think Parag Parikh as an organization was very small, I think, in 90s.
Yeah.
Then moved on to Birla Sun Life Securities as an analyst, and then you joined this company. So how has been your experience of last 30 years, if you can share it for our investors?
So I've been very fortunate, See, when I met these people and I joined them, I never knew they'll become the legends that they were. When I started Parag Parikh, it was a small broker. There was no mutual fund at that stage. At Veena Chambers, opposite stock market, we had a small office. But I was very fortunate because Parag Bhai was later on obviously wrote books and spoke a lot about
behavior.
Absolutely. So, he evolved into somebody great, but I was very fortunate to meet them when they were not the legends that they were. At his office, there were some great investors that would come, someone like Chandrakant Sampath. Many people have heard about him at best, but I've been fortunate. And I was a kid. I didn't understand 90% of the things they would say at that stage. I was just a kid out of college. But the fact was that very early you meet them, and I guess, at some stage, some things do rub off. I was fortunate about that. Then Birla Sun Life was a different journey in between. Even with Rakesh ji, when I met Rakesh ji, he was a successful investor, but he was not the legend. He was not the billionaire and the multi-billionaire that he was made out to be. So I think they have also been fortunate that you kind of have crossed paths with all these people. You knew them when they were not so famous or successful, and the good part is having worked with them, you really see them beyond what people perceive them or what people see them. People only see a bit about them, but they don't see. As I said, they may see the 30 minutes of what you see them on media, but the hours and hours that went behind. What was the person? What was the sacrifice? Those are things which people don't see. And I'm fortunate that that I find that those hours were a lot more to learn from than what people saw.
Sure, great. So in fact, in 2015, Atul, I had the chance to attend Bakshar with AGM with Ramdevji, and Parag Bhai was also there, and he met with an accident there.
Oh, that was the year.
Yeah,
okay. A really unfortunate thing.
I still remember then all of us had gone, and he was there sitting with Ramdevji till about 4:30, and next day morning we got to hear this news. That is. It was very unfortunate.
Yeah. I mean, just speaking of Ramdevji also, I think the third person, though I never worked with him, but he's been a great influence and a bit of a mentor for me, is Ramdevji.
Okay.
Again, another person, I think, great investor and everything people know of, but he's such a fantastic human being.
Right.
So I have the highest of respect for him. He's a very good friend, and there's so much to learn from him. So as I said, I've been fortunate. Parag Bhai, Rakeshji and Ramdevji. Legends in their ways, but people have known them. I have known them not for the legend bit, but I've known them as people.
Right. Because we work very closely with all of them. So now coming back to marathon. So first question is why it is called marathon? What was the reason?
So obviously I have a passion for sports and I used to run. And I realized that investing and running a marathon require the same mindset. Most people view the stock market as a sprint. Quick money.
True.
But actually you'll find all these three people we spoke about, the most successful investors, they were not sprinters, they were marathon runners. So there are three qualities I feel that you require to be a marathon runner and investor. First is belief. Why belief is so important is, that if I tell you that, you're going to run so many kilometers, your immediate reaction is no. You have to have belief in yourself. So also in investing. In investing, we all have a process and we will be tested. We will be doubted, self-doubted, externally, internally. But you have to have belief in what you do. You cannot change with the weather. You can't change with the season. So the belief is the starting point. We spoke about Berkshire, we spoke about Warren Buffett. I mean, there's no greater example of a person with belief than Warren Buffett. Second, belief is good, but you need to put it into practice. I told you about the 30 hours beyond. That is discipline. You have to really come in, do the reading, do the work. Hours and hours go. Lot of sacrifices are done. So even in a marathon runner, you think you can run those kilometers, but you have to wake up every morning. And you have to have the discipline to train. Just a thought that you can run doesn't take you to your distance. You have to train for it. So belief as an investor, as a marathon runner, discipline as a marathon runner, as an investor, and third is perseverance. Because the journey is not linear. The journey is not smooth. As a marathon runner, you will get injuries. You will get cramps. Your mind will give up. But you have to persevere. Even as an investor, you will have drawdowns. You will have difficult phases. You will have external doubts, self-doubts. But you have to persevere. So you have to have these three qualities as a marathon runner, as an investor. And I am a trend follower, a style of investing, which we can talk about later. So that's how I combine the two words. The mental side, which is marathon, and trends, which is the mechanical side or the quantitative or the intellectual side. So that's how the term marathon trends came in. So as I said, trading the markets or investing in the markets with the belief, discipline and perseverance of a marathon runner.
Great. So pick up your coffee and we'll continue.
Sure.
So when was the time that, Atul, you decided that you're going to take your own PMS license and then go about creating wealth?
So I was with Mr. Rakesh Jhunjhunwala in those stages at Rare. And obviously for me, he was a single client in that sense of the term. And the beauty was that the client had no limitation in capital. So it was a very large ocean. And at that stage, I think the bug really came about. And, we had some people from Rare who went out and started their own stuff, PMSs, etc.
Yeah.
So I think Rare has been a great incubation place for a lot of PMSs have actually started from there.
Yeah.
So I saw one of my predecessors doing that, and that sort of inspired me. So this was, I think, around 2015 or so.
Sure.
And that's when the whole journey started and things like that.
Okay.
So it was something which was coming. It was quite natural. And as time passed around,
Sure.
it became a reality.
Sure. Great. So my question from an investor point of view now, that if investor wants to give you a mandate, which scheme? So you have 2-3 PMSs.
My main flagship is a trend following PMS.
Okay.
This is something which has a 3-year plus track record now, 3 year and 3 months or so.
Okay.
So that is something that we have a flagship which is open to the public. Trend following, because let me just explain to you,
please.
is that,
My audience would like to know.
Yeah, it comes from a beautiful line. I will put it in very simple line. Of course, it can be very, very complicated also.
Yeah.
But Rakesh ji used to say this line in Gujarati. Vadhare vadhare levanu, ghatade ghatade vechwanu.
Okay.
That means buy strength, sell weakness.
Okay.
And that is something which I learned from him. And even if you look at the famous story of Titan, Rakesh ji has had multiple stocks and multiple failures also. But the interesting part was that wherever there was strength, it was his ability to hold and add to it, which is vadhare vadhare levanu.
Right.
And wherever he made mistakes, which also he had his fair share, he was disciplined enough to sell. So what you will realize is that this whole Indian stock market, right, there's been a lot of wealth created. But if you see the number of stocks where the wealth has been created as just a handful, there is a big survivorship bias.
Right.
We talk of those few names, HDFC, Asian Paint, blah, 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 etc., Siemens, etc. But you realize that for each one of them, there are 3 others which have got delisted or people have lost money. So what I realized is that the way of wealth creation is through the same principle, which is buy strength. Because there will only be a handful of companies that will make serious money. So when you buy strength, you are in those places. And in majority, people are going to lose money. But the moment you sell weakness, you make sure you're not in there.
Right.
So by that process of doing it regularly, buying strength, selling weakness, you gravitate, or your portfolio gravitates to those stocks which are the big wealth creators. And it is this process which is actually how the index also is built. One of the reasons people find it hard to build the index, because the ultimate trend follower is the index. Index is not passive.
Right.
The index is very active.
But it's
because
becoming even more efficient.
Absolutely. Because what is the index doing? The index is a collection of 50 stocks. Nifty we're talking about.
True.
The top market cap, or the stocks that are going up, or companies becoming larger, which is market cap, gets included and rewarded. Whatever is weak gets eliminated. So you'll find so many names of companies which were at one stage in the index have got delisted.
True.
And as investors, if you land up holding any of those stocks, the price you pay is tremendous. So buy strength, sell weakness is what is trend following. And that is what we do. And the most important thing is that it intellectually looks very obvious. But to do it with the disciplined way, year after year, month after month, is the challenge.
So my second question is, from an investor point of view, would you be looking at some kind of technical analysis there also when you talk about trend?
So we combine 2 areas. Again, this is something I learned from Rakesh ji. Yet the greatness of Rakesh ji was that obviously he was fundamentally driven. He understood companies very well, but he also had a very good understanding of markets and trends. He could combine this. See, most people tend to be in one bucket. Either they are fundamentally driven, they say market action is humbug. There are a lot of guys who only study price action, they say fundamentals is humbug. But from him, I learned the ability to combine the two. And I tell you, there's no book, no course which actually shows you there are courses on this and that. But the ability to combine is very, very difficult. Maybe something William O'Neill wrote on CanSlim. Maybe one of those rare outliers. But you'll find that the ability to combine these two. So coming back to your question is that we ultimately, as trend followers, look at 2 things. First is quality and second is momentum. Quality is fundamentals. So our first criteria, our first port to stop is actually fundamentally good stocks.
Okay.
But just having a fundamentally good stock does not mean that you will make money. You ultimately make money based on price.
Right.
We have seen right now also there are so many examples of wonderful companies that have not made money for the last 5 years. You know, there are
I agree.
multiple names.
Look at HDFC.
Multiple
And
names.
this is just for the example purpose.
Yeah,
It's
there
a
are multiple
disclaimer.
names,
Yeah, yeah.
But the thing is that ultimately you may have a good company, but it is also to be combined with price action. Because at a portfolio level, our performance is linked to the price action. So you have to combine good, fundamentally strong, quality companies with momentum. And momentum is not technical analysis as people see on television. Breakout, aa gaya, do
No,
rupaya,
no.
stop loss. It's
This is
more about
PMS,
it's
yeah.
more about understanding trends. It's more about understanding strength, relative strength, volatility, and various such factors. So when we combine quality stocks with momentum, we find that really helps us to give us marathon trends, which is what we are looking for. We are not looking for 1 day, 2 days. We are looking for long trends, marathon trends, because that 80-20 principle holds true even for investing. All the great investors, whether it's Rakesh ji or Ramdev ji or Warren Buffett's of the world, you'll find that their wealth is ultimately created by a few stocks. And what is the quality of those few stocks? That they were ultimately qualitatively good, which is strength in earnings, and it was rewarded by strength in price. When the two combine, you have marathon trends, which is what we are trying to achieve for our clients.
Okay, great. So my from an example point of view, I need to discuss this. For example, last 1.5 years, you saw that all the fundamentally good quality stocks were not moving up. But on the other side, you had stocks like, for example, Adani's stocks, they were moving up, and that's the reason your index was doing much better. I'm talking about BSE 500. In that situation, marathon trend, would you be looking at adding those stocks like Adani's of the world in your portfolio, or you would say no because they don't qualify the filtration?
So what will happen is that we are very clear about the filtration process. Whether it's an Adani or it's something else, we don't care. Because these are only stories. A group which was untouchable 2 years ago, today is touchable because some regulatory body somewhere has had a change of thought. Right? These are all very, very fickle. But as an investor, I can't do that. So we are very, very clear that we are interested in three things. We are interested in companies which have consistency of top line growth.
Okay.
You can have any name, any story, whatever is your beautiful thing, doesn't matter. Ultimately, you need to have growth, top line. We need to have operating level growth. And we need a certain consistency of return to investors, the ROEs, etc. When you find that companies meet all these three criteria, there are left, for whatever the benchmarks that we have, you're left with 150, 200 companies.
That universe becomes only
Absolutely. And ultimately, that is the only wealth creators. Lot of times stocks move which don't have these qualities, but it always ends badly when markets correct. So the fact is that if you look at, as I said, a handful of wealth creators, we did that analysis that, hey, these have been the wealth creators. These have been the marathon runners. What are the qualities they have? And when you reverse engineer, we realize that fundamentally these are the qualities that these companies realize. So when we look for that set of qualities in the fundamental universe, automatically we have a sense. Obviously, this is 200 companies, so we can't have a 200 stock portfolio. Then you overlay momentum, because in that also you don't want to be holding something which may be good on all these parameters but may not give returns to clients. So this is
how do
something.
you construct the portfolio? Like you have 15-20 stocks?
So we keep about 20 stocks with a good 4 to 5% sort of exposure to stock. But the secret is to let the winners run. Because that is when the power of compounding sets in. Like I learned that with Rakesh ji and Titan.
Right.
Titan became a disproportionate part of his net worth. And
He had
even today,
50% more than me.
even today it may be. But the thing was that if, like everybody, he said, nahi yaar, 5% is the limit, and I chop it, then probably his wealth would not be where it is. So the power of compounding gets into with marathon runners. As I said, it is not about success rate. People focus a lot that, I must have 100% strike rate, 90% strike rate, 80% strike rate. But you will find that even a 60%, even a 50% strike rate is very important. As long
Even at
as
50, you are home.
As long as the average winner is many times the average loser. It's a beautiful line by George Soros. He put it that it doesn't matter how many times you're right or wrong. What matters is how much you make when you're right and how little you lose when you're small. Then even with a 50% strike rate, you'll realize that you come home winners.
Well said.
And this is where the power of compounding comes in. Because where you are winners, if you let them run, then that number even balloons up higher. And if you look at all the great investors, that has been what has created wealth.
Right.
Those few stocks which have quality and momentum, and they have let them compound.
Right. So those investors who are not able to take care of their behavior, I think is the biggest lesson that we can learn is that even if you're 50% correct, you are home. You really don't have to really put too much of mind. Otherwise, you'll make it more complicated.
No,
So
there are studies done in the US among the top hedge fund managers, and I mean, I may be off by a little percentage. The best strike rate was a fund manager, Stephen Cohen, I think, 64%.
Okay.
That means the best fund manager, hedge fund manager in the US, also strike rate was 60% or thereabouts. Right? And which people would say, oh, that is terrible. People want 100% strike rate. But in the real world, that is the strike rate.
It is impossible.
The only difference is that these people who have that 60% strike rate let their winners run.
Right.
They let them compound. They let them run marathons and not sprints. Because the moment a stock goes up 10, 20, 30, 40, 50, say, बहुत हो गया, बेच दो यार, बढ़ गया.
Yeah.
But that very stock could also be up 500%. That stock could be up 1000%. And that one stock re-rates a person's life, portfolio returns. And that's the only way to do it. Because when you study all these great wealth creators, that is the consistency that you see in their lives.
Right. The other important aspect that I want to pick your mind, Atul, is that when to sell the stock. The exit is the most important aspect. And when I was going through your PPT and other papers, I've also learned that you give importance to exits.
Very true.
So, want to read your mind there.
So as I told you that, why exits are important. So I said that, there is a survivorship bias. We only talk about those stocks which have been winners. And that is where my 30 years plus pedigree comes in. Because in my journey, I have seen many stocks which were absolute stars vanish. And that is why it is very, very important to have the discipline of exit. Because in our investing journey, sometime in our life, we are going to get some of those lemons. Nobody is God, let me tell you that. But when those lemons come, even though you intellectually realize it, emotionally you are unable to press. The sell challenge is not intellectual, it is emotional. And as I said, for me, I tell people that I may miss some winners, but I will never miss cutting a loser. Because as I said, in my years, I've seen a lot of people lose a lot of money by not being able to cut their losers. So if you're able to consistently cut your losers, you realize that sooner or later you will get a large winner. And that risk-reward ratio, average winner versus average loser, will work to your favor. क्या होता है that in most retail portfolios, I go and meet a lot of investors. They say, sir, हमारा portfolio देखिए, and there will be some 200 stocks. 100 stocks. And then you realize what has happened. What is the reason that portfolio has grown so big? The reason is they were unable to cut their losers. And that is where the problem is. And then when you do a set off, you realize कि जो अच्छा share है, वो बहुत जल्दी बिक जाता है. Because the moment a stock goes up, people feel greedy or get nervous very quickly. But whenever there is loss, they keep standing. So this is exactly the opposite of what we do. And that is where our edge is. That what people do is cut their winners, ride the losers. Ours is opposite. Cut the losers, ride the winners. That is the only edge we have. And because we can do it with discipline. As I said, winners is still the easy part. Buying is still easier. Riding is still easier. But cutting losers is the biggest challenge. And there, the problem is not intellectual. The problem is emotion. Because there your ego comes in. Because the moment you cut your loser, you are accepting defeat. You are accepting failure. And that is against our ego. Ego works against it. And that is why it's very important, as I said, to have the discipline, the emotional thing. And for me, that ego is not there because, as I said, because of my long journey, I've seen a lot more mistakes done by not cutting losers.
Well said. So other thing, Atul, is that if we are in 2026 now, we've seen last 2.5 years, to be precise, have been very challenging from an equity point of view. Now, where do you see going ahead 2-3 years down the line? And what kind of returns one should expect from equity as an asset class? Because people had extraordinary expectation in the past, and they continue to have. So although whenever I get a chance to speak to our set of investors, I tell them to reduce their expectation level, because your nominal GDP growth, which was 12.5%, 13%, has come down to now 9.9, 10%. So what's your views there?
So when you study Indian markets, you will realize that we have stops and starts. So you'll find that we've generally had a very good 2-year bull market. Then the market gets corrective for 2 years. Then again it has a 2-year bull market. So what you saw was 2023 March, April, the market rally started, went up to September of 24. That was 1.5 year. But if you look prior to that, 2022 was not a good year. It was a bad year.
Yeah.
But if you look before that, 1.5, 2 years, 21, 22 were good years.
Yeah.
But if you look before that, 2020 was bad. So what happens, the market has a habit of spurts, getting everybody in, misplacing expectations, then sideways to down. Then again spurts, when everyone so I have this very beautiful measure, the moment I start reading articles or people's narrations that इससे अच्छा FD में पैसा डाल देते थे, I very often think that is the bottom time.
Okay.
And very often when people say यार ये FD तो सब बेकार है, equity में ही होना चाहिए, that is somewhere where the problem happens. So what happens is that you will find that this is human emotions at play. When everything should be sold to put in stocks, there is a problem, because life is not about all euphoria. Yeah. Those returns that people have seen may not always replicate. Right. And the moment the people get frustrated, which is right now, I also saw something, is recurring deposit better than SIP? Yeah. I just saw that article. And when I see that, I smile to myself, because over the years I've seen this. These also become very, very good indicators of emotional barometers, which means that there's not much to lose right now. So what I feel is that in the last almost now getting to 2 years, we've had a sideways market. 26,000 on the upside, 22,000 on the downside. We are midpoint at 24,000 right now. True. So we've done nothing for almost 2 years. True. And at these times, these emotions come in. But that itself becomes the beauty point. I feel that we are in this this kind of zone of around 4,000 points where we've been tracking. Mm-hmm. I do think that there is no massive bad news in India. Yes, money flows in, money flows back, reasons will follow, but when it happens, it will happen. And it surprises everybody. I feel that the next leg will take our market around 30,200 or so, which is a good 26 to 28%. Yes, nifty. And it could happen in a year.
Oh.
Okay, again, disclaimer, these are just my personal views. Sure. I could have a bias towards all this. But the fact is that historically I've seen these, that the market rallies, everyone gets in, frustrated, time-wise, price-wise, exits, next rally starts. Again, they'll come back, but not at 24 or 26. They will come nearer to 30,000. Right. And again, then the argument will be, अरे FD बेकार है, equity में पैसा बनेगा. Just as अभी क्या है, equity बेकार है, FD में डालना चाहिए.
So right now, if I give you a crore, you're deploying everything?
I think so. I feel so. Because also another thing I'm noticing is that how are markets behaving to news? See, in a bull market, very often a top happens that when, in spite of good news, the stocks don't go up. Yeah. Now it's the opposite. In spite of bad news, stocks are not going lower. There is umpteen bad news in IT. Look at what is happening to stocks. What happened to Accenture, what happened to IBM. But you'll find that Indian stocks are making a base. You'll find that Middle East crisis. I mean, there are rockets being flown and crude just spikes up $10, $15. But incrementally, we are not falling like how it was happening earlier. Every $2 move, the market used to fall a few hundred points. Now the crude has gone up by over $10, $15. You'll find that index is where it is. So when the market's not going down on bad news, that also becomes a very good basing point. Just as in the reversal, when the market doesn't go up on good news, very often a topping happens. So I feel optimistic about it. I feel
the margin of safety is
yeah, absolutely. The sentiment is bad, margin of safety is bad. There's a lot of bad news. Monsoon bhi failure hai, Middle East bhi problem hai, crude ka bhi problem hai, tech ka bhi problem hai, itne sab problem hai. But still market is not going down further. And now it's just a question of some good news, a little trigger. And I think maybe corporate earnings surprise us. Maybe the narratives or the guidances surprise us. And if we have a rally backed by that, I feel that the targets that I gave you could actually be a reality.
So other question is that, so you have some numbers in your mind in terms of that you look at this kind of ROE number, because eventually stock prices will,
That's right.
follow or mirror the
Yeah.
the earnings of the portfolio,
Yeah,
etc.
yeah.
So what kind of numbers?
So let me just, instead of getting very nitty-gritty to the numbers,
Sure.
let me explain to you the process. So what really happens is that, there are 2,000 stocks. Nobody can cover 2,000 stocks. So the first step is to look at liquidity. As I said, for me, sell is very important. So for me, very often, I may have a sell decision, but if the stock doesn't give me liquidity, there's a problem. And it very often happens in a lot of these micro caps. So one thing is we stay away from that, because for me, disciplined exit is
So you
important.
don't touch much.
No, I touch small caps, but I look for a certain minimum liquidity threshold.
Okay.
So our first criteria is liquidity.
So 150, 200 crores of market cap.
No, much more than
Sorry,
that.
profits.
Yeah. So the market cap will have to be much higher.
Yeah.
So we would look at the top 300 to 350 companies. in
More
terms of
than 3,000, 4,000 crores.
Absolutely. And then what happens is, the second thing is that we look for companies which have a little consistency of earnings. As I said, we look at top line, bottom line, and ROE. So we need to have a certain bit of historical track record, not just about one good quarter. So we are not turnaround artists, but we are trending artists. We are trend followers. We will never pick a stock at the bottom, because we find that bottom is only something you know in the future. It's an illusion.
Right.
What we try to look for is companies that have consistency. So we look for a certain consistency of top line, bottom line, and ROEs. Once we get that criteria, we also look for a certain acceleration. एक तो होता है historical, and second is accelerating. So the market rewards acceleration. The market rewards positive surprises.
Right.
So we put all this into a beautiful model, and we actually run it through these stocks.
Okay.
And we based on quarterly numbers, which are very, very good. We are not great believers in huge 10-year projection and 5-year projection. We find the world is so dynamic that we are unable to even know what's happening
Right.
1 week down the line. So we find those a little challenging. We are okay with looking at these numbers.
Sure.
And that's how we bring our universe down to 200 stocks or so. After these 200 stocks, as I said, it's very important to understand that where is the momentum. So we've created a lot of proprietary indexes. So we have created 45 industry indexes.
Okay.
And we realize that when stocks move, they move as a pack. Like let's say when defense industry was doing well, maybe a year or two ago.
Yeah.
It was a HAL, BEL, BDL, Mazgaon, Cochin, सब चल रहे थे. सब चल रहे थे. Nothing was spared.
Yeah.
In fact, what was spared in the end also moved higher.
Right.
So you find that always stocks tend to move thematically, industry-wise.
Okay.
एक time specialty chemicals का था.
So
All were
better.
doing well. So what we realize is 70 to 80% of the job is done when you are able to find the right pack. So we are always, in that sense of the term, a little concentrated in themes where the trends are. That is where our study goes. As I said, we've created 45 unique industry indexes. Like we have an index for wires and cables. It's a fringe. There are hardly 5-6 stocks.
Yeah.
But if you look at the stocks, that is probably the best performing industry sector as far as markets go.
Okay.
So we able to identify these themes.
Okay.
So along with fundamentally good stocks, we will then identify stocks which are in these industries. And among them, we again use momentum to pick, because I cannot also buy the full basket of 5 cable and wireless stocks. I may need to buy 1 or maybe 2. So what we do is, this is how we combine. So we look for quality companies in earnings, profitability, return ratios, and then we combine it with a sector, the theme that is playing out. And in the theme also, we like to pick the one with the highest momentum. So our aim is to bring quality and momentum together.
Right. So couple of quick questions. So
Sure.
what has been the churning ratio so far?
So we are not a very high churn. Again, people think that because we look at markets and trends, etc., that we churn a lot. We are not big churners. In fact, we are, as I said, long-term trend followers. So we may kind of once a month, we may replace a stock.
Okay.
Something may be relatively outperforming. Will replace something that is relatively underperforming. And we look at things in terms of relative to markets. We look at things relative to volatility. So we take those kind of things. It is not technicals as you see, breakouts, etc. Actually, it's a question of ranking. Just as I told you, we look at sectors and themes. So we've created a lot of these proprietary models which look at market more through cycles and more through, as I said, our ultimate aim is to identify some of those marathon trends and be able to ride them for the long term.
So my last question is, so what would be the bifurcation between large cap, mid cap, small?
So at the moment, we are actually overweight mid caps. We are 65% mid caps.
Oh,
Yeah, we are 65% mid caps and we are overweight mid caps. Again, we never take a conscious decision that I will allocate so much to mid,
It's
so much to
more of
large.
bottom up.
It is bottom up. At the end of the day, wherever the corporate earnings are coming, we will be there.
You will have to.
And wherever the market is rewarding, we will be there.
Yeah.
Today, the mid cap index is at lifetime highs.
Yeah.
Nifty is not. So not that I am smart enough and has that sense that, oh my God, this will do well. No. We just let the market decide for us.
Sure.
The market, as in Gujarati, they say, na, bhav bhagwan che. Price is God.
Yeah.
We let the markets decide. Our job is to pick good companies,
Yeah.
identify good companies, and then let the market identify. So we are overweight mid caps.
Tomorrow it can reverse.
Not in a day, but I'm just saying within.
No, I'm saying not tomorrow, literally, but 6 months, 1 year down the line.
Absolutely. Because
open.
ultimately we are trend investors. The trends change. And that is the reality of this market. Nothing is permanent. Nothing is never. I will tell you that PSU stocks did well in 2023-24. There were so many people who swore in their life because for last 20 years they had done PSUs and lost money. कि PSU stock नहीं लेंगे. But अगर PSU stock नहीं लिया तो problem हो गई. So that is what happens in our market. Never say never. Let the market decide. भाव भगवान छे. Price is God. Let the market tell you what to do. Your job is to identify good companies. Don't get into kachra. Don't get into euphoria. And then let the market take it up. That's
But
simple as that.
sometimes the good company also don't move for long period of time. For example, just for the example purpose again, HDFC is a good company, but for the last 5, 6, 7 years,
Absolutely.
it's not going anywhere.
You have quality, but where is the momentum? So as I said, in our things we have momentum. We can find I have 200 quality companies, I'll tell you. But the fact is that I need only 20.
You
And
need
when
momentum also.
I don't get that momentum, then the stock you mentioned is not likely to be in my portfolio. But yet, if you look at private banks, there are some at lifetime highs and breaking out. I won't take names. We have 4 in our portfolio.
Okay.
If you find that they are at lifetime highs. And these were stocks which you wouldn't have spoken about 2 years ago. So what you need is quality and momentum. And our uniqueness is able to combine it. Most people are in this or that. It is very difficult to combine the two. And that is our strength. And biggest challenge of investing is exit. To sell disciplined exit. Doing that, I feel, is ensuring that you can sleep well at night. You have quality stocks. You don't have sleepless nights. You have momentum. Hopefully it rewards you. It creates alpha. And you have discipline to exit. That in case something unforeseen happens, nobody knows the future. At least you have the discipline to exit.
Right. So with that, we'd like to conclude the session here. Thank you so much once again. Thank you, Atul, for taking the
Thanks a
time.
lot.
Thank you.